So welcome to 2026. It's Dan. Welcome.
It's good to be here.
It's our first podcast of the year. And this is a great time of year. In fact, in front of me, Dan, I have the year ahead reports from I don't know how many different firms, like maybe a dozen different firms. It's that time of year to collect the economic reviews from last year and the outlooks for 2026. So we have a bunch here. We've gone through them, including the daddy of all reports. This Goldman Sachs report is 144 pages, and believe it or not, it has 241 charts. So
naturally, that's why you gravitated towards it.
I read every chart. So clients will offer it up to you. Anybody wants to look at it. It's the most comprehensive year ahead report I've ever seen. So it's again 241 charts. So that's there for your viewing. So that's what we're going to do today. In January, it's always a good time to do kind of probably the equal parts reviewing what happened in 2025 and then discuss what we're thinking for 2026. But by all accounts, in fact, we're titling our podcast a historically eventful year because last year we were all over the place. If you look back, and by the way, we're looking back at our podcast and webinars, we just realized this morning that Dan and I have done these every month, except for one when we made the transition back in March. We skipped April of 2026, but we've done these every month since January of 2021.
Talk about slackers. I can't believe we missed that April episode.
47 out of the last 48 months, we've done these webinars or now in the podcast format. So it's good. But every year in January, what we do is we'll do this kind of look ahead piece. So it's a great time of year to do that. So when you look back at 2025, it was pretty eventful, right?
Yeah, I think to put that mildly, I think the other, not only eventful, but for many clients also it was a bit unsettling, right?
Right, very much.
So let's hop into some of that. I mean, it's hard to even go back and remember how many different items. I know you have a pretty comprehensive list, but
I'm looking at it now. It's ridiculous. Yeah, and it's kind of interesting though when you look at it, kind of came, if you go back to our January podcast from last year, it kind of came as we had hoped. What we had said back then was that 2025, if you look at it coming into last year, we thought it could have been a little bit of an everything rally, is what we mentioned last year, meaning that if interest rates declined a bit, so if the Fed lowered interest rates, which they did, and earnings held up, you could have a situation where 2025, you would have stocks and bonds both increasing together. And that's exactly what happened. But the path to get there was crazy. It was an absolute crazy year. So let's start by just talking about and kind of mentioning. I'll mention the topics and we can go circle back through. We have a lot of bullet points this month, but let's look at some of the crazy stuff that we really didn't expect. Some of it we expected, some of it we didn't expect. We thought going into the year would have been positive because rates were decreasing. There was a little bit of animal spirits ahead of the new Trump administration coming in. Some of the things we didn't really think about, we had the U.S. government purchase stakes in U.S. companies. And we all know they put a big stake in Intel, but also MP Materials and Lithium America. That was something we weren't really talking about. We had the longest government shutdown in history. It was 43 days.
Yep.
Nobody thought about that. The Fed, the Fed independence itself came into a kind of a threat during the year. We talked about that in several podcasts, even a lot of name calling between President Trump and Fed Governor Powell, right?
It's safe to say they're probably not great friends.
Absolutely not. Yeah, and we'll see. And that's it. That's going to be, we're going to talk about that later, right? Because that's going to be a big theme for next year. Next year, we're going to need to talk about the Fed because Powell's his term expires in May. So we'll talk about that. Liberation Day was a big one, right? We had Liberation Day where the tariffs kind of came out of nowhere. We knew Trump ran talking about tariffs, but we had no idea that they would be, talking tariffs on allies and other countries as well. So that was the highest tariffs we've seen in a long time. And then they softened that. Another one, third largest budget deficit in history. We're now like 2 trillion. I'm sorry, did I say 2 trillion? 2 trillion deficit, right? But the debt, we're approaching in 4 months, we're going to pass 30 trillion.
Yeah, which is, close to 100% of GDP, right? It is a really, it's almost hard to wrap your mind around a number that large.
And we expected that, and we're expecting it again this year.
Yeah.
But the fact that it came in near 2 trillion again is amazing. Uh, Another thing, probably surprised about. We talked about this possibility, but the U.S., even though it had a great year, the S&P was up something, finished something like 16%. I saw a stat this morning. U.S. underperformed 70% of developed countries out there. Okay, so we had, for the first time in a long time, other countries, Spain, Italy, Brazil, China, outperformed the US.
Yeah, and it's again, we've talked about that from the concept of diversification over many of these podcasts and webinars throughout the years. But I think one of the interesting things, and we'll probably touch a little bit on it out of the Goldman report, was that despite the fact that foreign markets kind of outperformed U.S., U.S. still is kind of the preeminent
Right.
leader in that space, and there's a whole lot of great stats in terms of productivity and portion of the overall capital markets and what that we can get into. But interesting year, was good to see other parts of the world kind of, kicking into the bucket, so to speak, and helping provide, a better, set of returns for clients.
Yeah, and a big part, I think we did expect this, a big part of the outperformance was the weakness in the dollar. So if you
Yeah.
look at it, there was a 9% decline in the US dollar in 2025, which, by the way, was the worst year since 2017. Okay, so that helped the foreign stocks do better. And we also had, a lot of geopolitical tension. We had, with China and Iran during the year.
Yeah, and then just wrapped up the end of 2025 with the situation in Venezuela. I mean,
Right.
it was a very eventful year, and it's kind of you think about to January of 2025, and you had mentioned a little bit about animal spirits coming off the election. There was a real sense of euphoria in the stock market about kind of what was going to happen and was going to be a repeat of Trump 1.0. Um, and then, you fast forward a couple months later to Liberation Day and just the sheer panic and pessimism. What a reversal. And then, for the back half of the year to be relatively calm despite all these things happening, it was truly a kind of a stomach turning year in that way.
Yeah, I mean, wide swings to say the least. So we had started the year 2025 with a little bit of a mini rally. Then you mentioned Liberation Day. We had about intraday, about 21%
Yeah.
decline on the S&P. It's like 27% decline on the Nasdaq during April. It all ended around April 9th, and then a big increase from there. So it completely, and it was a classic V-shaped recovery. We
Yeah.
had a waterfall sell off and a huge increase.
And if you think about all that in that scenario, right, the banking sector remained strong,
Right,
credit stayed calm,
right.
and 10-year
Surprising.
yields, right, were more or less range bound for the course of the year. We got a little bit of steepening in the curve, but with all of those different variables, you could have easily seen really big dispersions in those areas of the market, and they just kind of shrugged it off.
Absolutely. So let's go into our first chart of the year because that'll go wrap up a little bit of a review of 2025. And here it is here. If you look at this, we've shown this to clients before. We call it kind of our quill chart. It's an asset allocation, returns of different, subclasses. And what you see in 2025, and it's the only period really on that chart that it has it to this full extent. Every category, the top performing category was emerging market equities up about 34%, developing capital markets up 32%, large caps, I mentioned it before, up about 18%. Um, Even this, all the way down to cash, cash was at 4.3%. Everything besides REITs outperformed cash. So I think that's a positive environment. We had some broadening out there as well.
Yeah, and it's very rare you have a year like that where everything is positive. So I mean, it gives some hope, and I think 2026 will be kind of a continuation of that trend. Even though all the various different sectors and kind of asset classes did relatively well, there was still some pretty big dispersions in terms of
Right.
large cap growth in particular was like a real bright spot again for multiple years in a row now. But I think going into 2026, seeing the continued participation of mid caps and small caps, maybe a little bit of reversion to the mean on international side, but
Hmm.
it is it's where you want to be. You don't want to have such narrow leadership. Um,
Where it's just AI and
just
nothing.
a
Right.
correct, yeah, exactly.
Well, and we also, with this chart, we have to touch on the white. box, and the white box is a basically it's a pretty generic 65-35 blend between these different groups, and and that turned out to be another great year. It's about up about 16%. So a lot of our 60-40 portfolios were up 15% last year. So I think that's also a positive trend.
Absolutely.
Because that's where most people are, right? Most people are not allocated to one style box. So, the only other category, and there's maybe I missed something in this long exhaustive list of things that happened in 2025. Big beautiful bill passed at the on July 4th as well. It's amazing that I almost forgot that. With all in a normal year, that would be kind of big news, but so many things that are happening, right?
Now, with everything that's gone on since the passage of that bill, do you, this is a little bit of a, prognostication at this point, but do you expect any other kind of substantive or term defining policy pieces out of the Trump administration over the next handful of years, or do you think we've pretty much kind of seen what we're going to get?
I was telling a client this yesterday. It's a great question. I think it's so loud that it's almost quiet, right? Because you talk about just news. You mentioned what went on in Venezuela this weekend, but it's so exhausted. I'm exhausted trying to keep up with Trump because there's something every day, right? So we know we put the category out that it was basically what we ended up having was an historically eventful year for 2025. There's gonna be a long list for 2026 as well, right? And reason why I say it's so noisy or loud that it's kinda quiet, I think for the most part, we learned that during the tariff tantrum, that basically I think what the market does is it shrugs off a lot of that, and it kinda goes back to fundamentals, and going back to fundamentals is looking at things like earnings per share, which we have a chart on that. It had a great year, an
Yeah.
increase there. A lot of the other stuff, the stuff ends up, or whatever is going to come out, ends up being noise. So what the market does, it becomes a little bit quiet, because what used to be major announcements kind of come out every day because Trump is so active that I think the market's kind of put some of that stuff aside. At least that's what it feels like to me.
Yeah, I think that's a pretty good assessment, and yeah, I suspect when we sit down in January of 2027, we're going to have no shortage of topics, events, and things to reminisce back on and discuss.
So let's start that, and we can drill back in depending on time on some of the other stuff. But I'd like to spend some time talking about what we think is going to what's going to transpire in 2026. When you look through all these reports, for the most part, it's pretty positive. The economy is doing pretty well. The economy's growing. The earnings per share of the companies that are growing. I think the big items for this year are it's going to be all about earnings and all about the Fed, right? So if the Fed becomes the Fed chairman, we mentioned Chairman Powell, his term expires in May, so they're going to replace him. By all accounts, they're probably going to replace him with somebody that's a little bit more dovish, right, than hawkish, if you can say that Powell's been a little bit hawkish over the last couple of years.
Yeah, and it was interesting. We were talking about a new Fed chairman here, and I think we heard Jim Bullard come out and basically make the case that hey, rates where they're currently at seem to be appropriate for what's
Right.
going on in the underlying economy. So it'll be if they do have a more dovish chairman in there, you might see more of a chairman led Federal Reserve, kind of
Right.
harkening back to maybe the Greenspan type era, and less of this. Kind of communication by committee. So it's going to be an interesting time, and I also think that because of that, you might see a period where, hey, the Fed confirmation may take longer than normal, and they're generally not short processes to begin with.
Yeah, I looked at the last two you had when Powell got when he came in, it was 79 days, and Janet Yellen before that was 82 days. So that confirmation process, or from what I'm hearing though, they can start that beforehand.
Yes.
So they might try to put that through Senate beforehand before Powell's term expires in May. So we'll see. But the Fed does matter. The slide two we're going to show today is a great slide from one of our favorite people, Art Cashin, who unfortunately passed away in December of 2024, was a long time, 50-year UBS employee. But he had this old saying that I heard many times: "It's bull markets don't die of old age; they're killed by the Fed, right? There's some truth to that, and that's what we're worried about. If we know the Fed, the markets for the short term, they like the Fed to cut rates, and they like the Fed to be what they call dovish.
Yeah.
Over the long term, though, that has there's a risk of inflation there. So we'll see how they go.
Yeah, and I think that's one of the big reasons right now with the Fed generally that there's such disagreement amongst the various governors. Is just that inflation has remained, you know, uh, kind of naggingly persistent at these elevated levels, and that's not necessarily the environment that you're going to normally look to cut rates in. But I think that's still the direction we're going to move.
Yeah, so and the Fed does matter, Dan, and that's why I love this slide from our old friend Art Cashin, floor director in the New York Stock Exchange for over 50 years or maybe 60 years. But his quote that I've heard him say many times is bull markets don't die of old age; they're killed by the Fed, right? And that's um, and what we have going on this year potentially is I think whoever Trump's going to nominate, we're probably going to hear that pretty soon is going to probably be a dovish person, right? Because they're auditioning. Trump wants rates lowered. That's great for the short term. So that's probably a positive for 2026, but it could end up being a negative in the long run if it causes inflation, right?
The one of the things that struck me too, I'm thinking back to when Powell was first brought on as chairman. They had a fairly warm relationship at the start, but then
Right.
during COVID, it really started to deteriorate, and it'll be it'll be interesting to see what the new dynamic is. I mean, I know there's a couple front runners for the job. It seems like he's got a pretty warm working relationship with, but
The
I will
two Kevins
personally,
are in the lead,
yeah, the
right?
two Kevins. But I'll personally be interested to see how that relationship evolves over time, and if when put in the job and faced with kind of the full set of facts on the ground, if there isn't some moderation or if they do just kind of move in that, you know, maybe overly dovish direction.
Right, and so that could be and we're gonna do a segment if we have time at the end of this, we're gonna hit you with, like, 5 different issues, and we're gonna vote whether they're positive or
Or negative.
negative for the market. I would say, to tip my hand on that, the Fed probably although, again, Powell took about 80 days to get his nomination passed through the Senate, and Janet Yellen took about the same, about 80 days, so we're a little bit more fractured right now, or maybe a lot more fractured now, so that confirmation process could take a while to get that through the Senate. But when you get the actual person in, it might be a positive. It might be a stimulant to the market in 2026. We will see. It'll be added to the long list there. So this year is going to be about the Fed. It's also going to be about earnings to see if because earnings surprisingly continue to increase
Yeah.
this year. In fact, this chart came from the Goldman Sachs 144-page report that I mentioned. What you see here, if you look at the chart 3, it shows the S&P 500 going back from 2016 until last year. It was about a 10-year history, and you see the moves in the S&P where it's going up and down, but earnings have kind of tracked, right? So earnings typically, if you're going to talk to somebody in business school and you said what makes a stock go up, it would be the first answer would be earnings. There's other factors, the overall economy, but the earnings estimates for next year are pretty strong. Goldman Sachs is expecting EPS for the S&P 500 increases of about 12%. Other firms are even a little bit higher. I think Goldman's 13%.
Yeah, and undergirding kind of the strength and continued positive expectation for U.S. earnings is it really goes back down to some of the I think structural advantages of our economy, right?
Hmm.
And specifically our workforce. I mean, U.S.
Right.
labor productivity per worker still remains the highest globally. Um, and in addition to that, our corporate earnings growth has consistently exceeded non-U.S. developed markets, and there's nothing that at least in the short term, would indicate that that trend is going to reverse or alter. Um, we are uniquely positioned, and I think it's one of those years. 2025 was kind of one of those years where people, started in some cases rightly, and maybe other cases a little, hysterically started to question. Can the U.S. remain a dominant power in the
Hmm.
world and a dominant player? And we just have so many structural advantages from a geographical standpoint, from a innovation standpoint, from a mindset and work ethic standpoint that I think, these are, the intangibles that continue to drive, this really robust US earnings cycle that we find ourselves in.
Yeah, in fact, the title of the Goldman Sachs year ahead piece is "The U.S. Resilience is Resilient," right?
Yes.
So they're agreeing with you and kind of expecting the U.S. to continue. Not that certainly if the dollar weakens again this year, the international markets will have a little bit of their wind at their back. But let's look at another slide here that shows that just looking back for the last couple of years, if you look at the components of the S&P returns, uh, 2025 was mostly due to earnings increases. You had, about an 18%, it was like 17.8% increase in the S&P 500. Where did that come from? About 14% of it came from the S&P 500 earnings increase, right? So looking ahead to next year, Goldman Sachs is expecting about a 12% return in 2026 this year for the S&P 500. Basically, they're expecting all that to come from earnings. They're expecting earnings to increase around 12%. It says about 11% on the slide. So most of the returns this year, if earnings hold up, the market should hold up this year.
Yeah, and I think a lot of the again the key inputs that would allow earnings growth to continue remain intact.
Right.
Um, there's some underlying weakness in the economy and the labor market and things like that, but then you also have this continuing AI super cycle that is adding to U.S. productivity.
Hmm.
And it'll be interesting to see as well as companies. We talked about this a little bit last year on some of the various podcasts, but we're in probably year 3, year 4 almost of a 10-year build out for AI, and we're
Hmm.
we're entering that phase where you're gonna start to see, obviously continued focus on CapEx and spend there, but now some of the downstream effects trickling into these individual businesses and seeing, hey, how much more productive can the US workforce become than it already is? What sort of gains might we see in software related companies that have kind of sat out the AI craze so
Hmm.
far? What does that mean for US productivity? So there's a lot of structural advantages still in place that I think, yeah, I agree with Goldman's assessment on that front.
Let's change gears a couple. I have some top, and these are surprise topics to Dan. Our clients probably wouldn't be surprised that know us, but a lot of the topics we're bringing up, I haven't even discussed with Dan. So he shows up for podcasts blindly. But a couple items I want to get your opinion on, and we're still fractured this year. So,
Mm.
if you look at there's a term they said, people looking at the economy through red goggles or blue goggles. There's University of Michigan Consumer Sentiment Report that comes out every
Yep.
month. They've been doing that for 50 something years. We've shown the slides before. But it's amazing the differential between if Republicans think the economy's good and they expect the economy to continue, Democrats think the economy is really bad. So if you hate Trump, it's a bad economy. If you love Trump, it's a good economy. Does that continue? I would say 100% yes. In 2026, if anything, we seem to be drawing further apart. There's another term economically. You're hearing it's a K-shaped economy, where the rich are doing well and the rest are struggling.
I think broadly that remains intact. I think the one area where you might see, some consensus among both viewpoints is costs still remain very elevated. And I do think that supporters of the president have been willing to kind of deal with a lot of the underlying pain in the economy from a wallet standpoint.
Hmm.
And I wonder how long that patience lasts if you don't start to see some really, notable improvements. Um, you know, the last couple days, I think the administration has taken a tone that is very more outwardly focused from a global policy standpoint, foreign policy standpoint. And I wonder too, how does that necessarily resonate with the base in terms of, certainly, some adventurism in South America is less America first to
Right.
some of them from a monthly standpoint. So I don't know if that starts to kind of crack that dispersion, but
Hmm.
if you just go out there and you're having conversations with friends and family members, and I still think those camps are very much intact, even though, maybe around the edges there's a little bit of fighting now.
But I would say in 2026, expect a continued what I'll call the Trump put.
Yeah.
And the Trump put is, The market goes down. We saw that in April. I think part of Donald Trump's a big part of his program is he wants to be strong on the economy. So we're
Mhm.
heading into a midterm election year. I think he's going to do everything he can to keep the economy moving because with midterms, the Republicans are not going to retain their status if we have a bad
I
economy in the
I kn
first part of the
yeah,
year. No,
and I know a different party and probably not a popular strategist on the Republican side of the aisle, but I believe it was James Carville that said, "It's the economy, stupid."
right.
And, yeah, I think going into a midterm election year like this, there's gonna be a lot of focus from the administration on kind of shoring up some of the weak spots and giving people a better overall
That
kind of
Trump put, maybe we
yeah,
have a Fed put. It
yeah.
should be, relative head. I mean, it should be a tailwind for the
Yeah.
economy
Well,
this
and
year.
think
We'll
about some of
see.
the bigger consumer areas too, like, think about housing, right?
Right.
If we do have a more accommodative Fed and you start to see some movement in the 10-year where, mortgage rates potentially moderate further, you start to kind of reinvigorate the housing sector,
hmm
that certainly would, put people in a more positive mindset.
Okay, I want to bring up something that's really want your opinion on it because it affects people your age more than people my age. But I'll call it like gamification of investing. It's out there. It is this year we saw. You can buy stuff on your phone. You can bet on everything. This morning. We were looking on what was it? What you looked on the poly markets, and we looked on the poly markets um, to see what percentage probability there was to the Supreme Court overturning the tariffs. That's something we're worried about. That could come out on Friday, but today, what were the percentage of is that?
Was
We're looking it up
there
now.
was 2, one was a 26% likelihood that the Fed upholds the tariffs, the other one was a 21% likelihood.
All right.
Um, But yeah, I mean, between Polymarket and Kalshi and yeah, it seems like everything now you can take an opinion or make a bet on pretty much anything. And that cuts both ways, right? Initially, thinking about Robin Hoods of the world or whatnot, where you started to get a broader kind of swath of the American public and
hmm
interested in investing. At the time, you know, there were some real positives there where people started to think about their future and plan ahead. On the flip side now, as we've seen sports gambling and now Polymarket, Kalshi, where you can bet on anything, kind of go through the marketplace, I tend to think people have lost the plot a little bit, and now
Right.
it's become more about instant gratification and dopamine rather than really planning for the future or making an informed decision. So I do worry about how the gamification of just life in general has kind of spread through out society.
Yeah, no question about it. And I've shared this with you over the last couple of years, teaching college seniors in finance. A lot of them tend to be on the betting sites, and I've had more than one approach me over the last couple of years, say, "Hey, can I get some advice?" And the advice is that the problem is they have a ton of debt, and it's all that the debt is incurred on their cell phone, betting on sports and betting on crypto. I mean, you can go in apparently on some of these apps, you can get crypto is already kind of a levered asset, but you can get 10, 20 times leverage on a crypto asset and do that on your phone, and that to me seems a lot more like the casino than it does, investing.
Well, for any of the younger audience that spent any time on Reddit, there are ample threads there just
Yeah,
where it's basically pictures of young kids and their portfolio values going from all-time highs down to zero, and it's pretty depressing to see because you're making bets, and it's hard, especially when you're a young person. It's hard to really quantify or assess what sort of risk you're actually taking. You think you've got lots of time and ability to recoup from these things, but there's a lot of bad behaviors being built right now because it's so easy to interact with the market and these various gambling sites.
great. Yeah, no, hopefully, yeah. I remember my dad coming home with somebody at work had football pools back in the day. We had football pools, and that was pretty exciting as a teenager to be able to bet on a couple dollars on a football pool. And now, I'm glad I didn't have a cell phone to be able. I'm glad I didn't have a cell phone for a number of different reasons back then. But let's shift gears to a couple other issues. We've touched on a couple of these, but let's go through and vote on whether we think these are positive and negative to look ahead for 2026. We mentioned the Supreme Court decision that could come out as early as Friday. In fact, we're taping this on Wednesday, January 7th. On the Supreme Court website, apparently yesterday, they announced that some of the decisions are going to come out Friday at 10 a.m. That may be one. It could be as late as April. But the legality of the tariffs is an issue. In fact, and the poly markets, these betting sites, are leaning heavily to the fact that these are going that the and it's based on the November hearings that they had. They're betting that the Supreme Court is going to say the tariffs are not constitutional. So that could have a negative effect on the markets, although it seems like Trump's team has plan B, C, and D on other ways to push these through. But what are your thoughts there?
Yeah, I would say, that the headline probably will be not great. But if 2025 taught us anything, it's you know, be mindful of the headline, but you know, kind of hold the course, right? And
Right.
have a longer term view. So yeah, some short term uncertainty. I could certainly see that. I think though I would tend to agree. I think it's probably highly likely that they lean in the direction of striking them down. But I can't imagine the administration is going to roll over on that, and they'll probably have something ready to roll.
Again, I think it's noisy, and then there's a quiet in the market
Yeah.
because you can't. These things are quickly moving. Midterm elections, I would say, positive or negative could actually, that one could be both, right? Because I think one thing it does, in the first part of the year, I think there is that Trump put that Trump's going to do whatever he can to have the economy stimulated in favor of to help with the elections. What do you think, positive or negative for the midterms?
You know,
That's a tough one.
that's a it's a tough one. I think, the sweet spot, if we end up with a situation where we have kind of divided government, right? Maybe the Democrats make some gains in the House, but the Senate remains, a pretty similar split to what it is currently with kind of narrow Republican control. That probably is neutral to a positive for the markets. I think if you see kind of a resounding move in either direction where, either the Republicans take a much larger lead in
Mhm.
Congress, or conversely, if the Democrats kind of have a blue wave, I think that could be either one of those scenarios could be a real negative event for the market. I think, we don't like uncertainty in our daily lives, but the stock market likes the gridlock of Congress when it presents itself. So, that would be a positive outcome, I think.
Okay, yeah, and then the most important question I think would be, are earnings gonna hold up? And maybe, fifth with that would be, is AI spending gonna call, but they're interrelated, right? Because a big part of that, big part of the earnings is what we're gonna do with AI spending, right? But in the Goldman Sachs report, they're predicting a solid year ahead for US equities. I mentioned that they're thinking the S&P will return about 12% as a prediction for the year, and they put a healthy price target of about 7,600 for the S&P 500 year end 2026. When you look through all the other reports, Morgan Stanley, Bank of America, a lot of smaller companies, UBS, they're all hovering around that 7,500 to 7,700 category, which would put it anywhere from 10 to 15% returns. And they're mostly all predicated on earnings increase because with a PE multiple of around 22 times forward earnings, we probably can't live for long with higher multiples. So the only way this is going to continue is if that chart continues, that first chart we show, which is if earnings accelerate. A lot of that's going to be predicated on AI spending, right? And really AI kind of producing some profits. But I would put that solidly in the positive category, and that's why we're thinking 2026 will be another good year primarily because of earnings.
Yeah,
Your
and
thoughts on that?
touching on AI spend, I was looking at some reports from Goldman. Their expectations is another 527 billion in 2026, and that's just from the
Wow!
big five hyperscalers. I
Wow!
read a piece
Yeah.
from Gartner. They were looking at total AI spend, not just capex, for 2026. They're expecting $2 trillion globally. So I think this theme has legs. It continues to have legs, and it will be supportive of global economies. It's at some point there will be that real question of sentiment of, hey, what's the end result? Or where's the earning flowing through? Where's the the profit from all this spend? And that is the biggest concern I have in the back of my mind is at some point do markets or investors kind of say, hey, hyperscalers, you guys keep spending, 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 like show me the beef, right?
Right.
And kind of force them to reverse course. But in the near term, expectation is that continues to ramp up, and I think that provides, a solid floor of support for the economy.
Yeah, another positive, and it's a contrary indicator, is that I know Tom Lee from Fundstrat Global. He's a perma bull, but one, he calls this the most hated V-shaped rally in history, and it's the sentiment is negative, which is a
Mhm.
contrary, opinion, right? So with the set, you're looking, even though the year ahead numbers on the top line are pretty good for some of the institutions. There maintains a healthy degree of skepticism. That continues. That's a positive for the market.
Well, yeah, consumer sentiment is not bullish right now. So yeah, I think that a healthy bit of skepticism there, and that is historically proven to be a good contraindicator. So until we see that change precipitously, where we start to see some euphoria or real
Mhm.
positivity in the market from a sentiment standpoint, we're probably in a pretty good spot as contrary as that seems.
Yeah, it looks good. The economy looks good. Earnings look good. So for the most part, the thesis we want to gather from this podcast is everything looks pretty good going into 2026. There's a lot of unforeseen events. So the advice would be don't try to trade around all these. In fact, I skipped a bunch of slides. I didn't use all 200 from the Goldman report, which you're happy about that. But I think what we're going to hammer home at the end is to remind people you can't trade this market. You can't trade any market, but this is even more difficult. So I'm going to show a couple slides that'll bring that point home. And we've shown some of these in different fashions before, but I mentioned Tom Lee, so I'll show a slide that he just put forward last week. And if you look at the stock market since 1928, okay, it's amazing. The S&P has returned from up the end of last year about 8%, not counting dividend reinvestment there. So about 8% return. And if you went out and just skipped or missed the 10 biggest days every year since 1928 would be pretty hard to do. You'd be pretty unlucky, but just 10 days a year, you get a negative 13% return over that time frame. And if you look at it just in the last 10 years, so since 2016, same thing occurs, about a 14% return for the S&P 500. You miss the 10 up days, it's negative 9%.
Well, that kind of goes back to what we've been saying, all along, and I know we sound like a broken record now over the past 4 years, but just the importance of staying invested and sticking with your plan, right?
Right.
A year like 2025, it was easy to get nervous and to think, oh my gosh, I need to I need to take action. I need to shift my allocation. I need to change my plan. And the reality is that, those that have the kind of patience and wherewithal to stick to the plan and weather out these storms tend to do pretty well over the long term.
Yeah. So we'll show it to you. Two more slides because that's such a great point that here, this is from JP Morgan, their guide to the market, which is a great piece. They looked even for the last 20 years. So this goes back from 2005 to June of 2025. So you had, again, S&P about a 10% return fully invested. If you just missed the top 10 days during that entire period, you're down to 5.6%. So 10
Wow.
days out of a 20-year period. And if you miss the biggest 60 days, you can see on the right side of the chart, you're negative 4.3%. Just so Dan, I don't know, can you tell me when the best 10 days of the year are? And
I
then
wish I could because I would probably be sitting on a beach retired right now.
right. And the last way to slice and dice it is if you look at it even year by year, let's even just look at last year. Last year we had about a 16% return. Again, this is not dividends for the S&P 500. If you missed the 10 days, biggest days last year, you're negative 9%. So it
Wow.
pretty much is every year. So that's all we need to hear to know that we can't trade this type of market. But what we're doing is, as we're talking to clients over the last month or so, it is important to rebalance, and it is important to talk about your risk tolerance. So one of the things that I realized last week with a client is that, we set them up 65% stocks, 70% stocks. And it's been a few years and is really enjoying the markets, but now he's up to like 86% stocks because the stocks have been growing more than the bonds. So one of the things we're going to be talking to clients about the beginning of this year during our conversation is the importance of kind of rebalancing or maybe, reducing the stock allocation. And one of the areas that we can move to is value is doing a lot better. So a lot of when we dissected his portfolio, the growth stocks in the portfolio have been growing more than the value. So one of the things we did is we just took some money off of growth and added it to value. The good thing, if you remember from chart one of this conversation, value also had a good year. That VTV, which is the Vanguard Value Fund, we use a lot of that, was up like 15.8% this year. So it pretty much gave you S&P returns. That hasn't happened in a while. Goldman Sachs and the rest of the pundits are predicting that we might continue to have a broadening out so we can be a little bit more conservative with things like value.
Yeah, and I think we've talked about that, a number of times, just the importance of, you know, avoiding that feeling inside or that desire to kind of chase the hot dot, right? Because
Mhm.
that's generally not the direction the market will move going forward. Now, I don't think AI and large cap growth is something that's going to like fall off a cliff
Right.
in 2026 or following years, but certainly there's a lot of wonderful companies that have a more value type tilt that, while performing well, have certainly lagged the broader market. And I think there's a great degree of opportunity there.
Great. Anything else in that Goldman report that we didn't cover that you think is notable or important for us to bring forward?
No, I just, the big kind of takeaway, I would say, if, and again, and it is a monstrously large report in a good way, but it is a big read. But I would say that the kind of overall theme that I took from it was, not to ignore risk or ignore these headlines that we see in the marketplace, but don't confuse the noise with like a structural
Hmm.
change in the underlying economy or the underlying markets. And I would say if you're going through periods of time or you're experiencing that sort of stress, you know, I know we always say to call us, but please take us up on that. Call us. Let's talk through it because I think it's just, trying to sift through what will be another busy year from a news cycle and figure out what's really important to you versus what is just, anxiety that maybe you don't have to worry about.
I agree. And you remember there was the TINA acronym during COVID. The TINA was there is no alternative. And the idea back then was when interest rates were at zero and money market returns were zero and short-term bonds were at zero, there wasn't a lot of other places to go. The good thing is going into 2026, there are other places to
Mhm.
go. Money market rates are still about 4.2%. They're down from 5.5%. Uh, we're still predicting that the Fed's going to cut rates, and we mentioned that even the new Fed dynamics would make it more kind of dovish, so more inclined to cut rates. So you should going into this year should have a good return for bonds, meaning if you get corporate bonds that are near 5%, and then if rates decline a bit, you could have some total return on bonds that's even a bit higher than that, could be 6 or 7%. We think earnings will grow 12%, so the market should do well with that. So, but you don't have to just do the Magnificent Seven or AI stocks. It could be a broadening out. We're expecting small caps should do a little bit better. But remember, small companies tend to have a lot of variable rate loans. So they do well when rates decline. So if interest rates decline, that could benefit small caps. Dollar still may be weak this year, which could help international stocks. There are a lot of categories and a lot of areas that we're able to move. Gold and silver, we should have mentioned that probably sooner. A little scary there because of the run up they made.
Yeah.
Gold had a tremendous year. We have for most clients, we do have 2% or so in gold funds. I'm not sure I'd want to add there right now. Silver is up even more.
No, but if
Yeah.
you step back and look just kind of and from the broader commodity standpoint, again, if you're of the mindset that this AI super cycle is kind of here to stay, and we've got continued years of build out, a lot of these rare earths and commodity inputs will continue to be, really important components of that story. And it's while I wouldn't probably chase gold or silver, there's other commodities or just general commodity exposure that may make a whole lot of sense.
Totally agreed. So what we're saying this year is don't go triple leverage on some crypto fund, right? You don't need to chase things, and don't try to trade this market. Invest in the market. We'll be viewing these reports like the Goldman Sachs, 144-page reports. We'll stay on top of this. We're committed to communication this year. We have podcasts planned for every month, but we're also going to do some special guests. We're talking to somebody from J.P. Morgan today after this podcast. So we're looking to get them on the show. So feel free, clients, keep your questions coming. Most of your questions that came through the year are actually the what we use to put these podcasts together. So if there's something on your mind, ideas on how we could do things better, let us know. But plan on this year, we're probably going to expand the podcast to have, special situations as well. So
Absolutely. And I look forward to getting some input from, we have a number of great partners here at the firm, and looking to get some of their inputs, into these podcasts as well, and start to kind of expand that a bit. Um, so grateful for all of you in 2025, and so excited for what 2026 has in store for our clients and for the firm.
great. And thank you. As always, thank you for your trust and confidence. And we will see you on next month's podcast. But between that time, feel free to reach out to us and to chat if any concerns or questions. Thank you again. Have a great day.
Cornerstone Private Wealth is an independent financial firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Cornerstone Private Wealth Partners provides all investment advisory services through Concurrent Investment Advisors LLC, an SEC-registered investment advisor. Concurrent Investment Partners LLC, DBA, Cornerstone Private Wealth are not affiliated companies. The items discussed are the views of the presenters and not of Concurrent Investment Advisors LLC. The information provided in this podcast is for informational and/or educational purposes only and is not in any way to be considered investment advice nor recommendation of any investment product. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be more or less than originally invested. Concurrent Investment Advisors LLC and Cornerstone Private Wealth is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. Please consult with your attorney, accountant, or tax advisor based solely on your individual circumstances.